Well, as our attendees join us, I am so glad to be at the end of the year, one of the shortest and longest years we've had yet. I feel like it's a repeat of 2020. Lots of time out there. I'm Melissa Joy, founder of Pearl Planning and Financial Planner. And I am so pleased to be joined by the rest of the Pearl Planning Financial Planning team. We've got Alexa Kane from the Dexter office, and Hannah Near, who works remotely, but mainly works with Dexter clients, and Melissa Fradenburg from our Grosse Pointe office. Thank you, ladies, for joining us, and thank you to our audience for attending. I know there was a lot of interest in this presentation, and we will have a recording. So if there are people you know that missed it but would be interested, it will be up on our website shortly. And we will also make sure to send you a copy in case you needed the link. But without further ado, let's dive right in and make sure we make the most of your time this afternoon. And so let's talk about year end. I'm going to share my screen. Alexa, can you see this?
Yep.
Okay, great. Okay, welcome again. Here we go. To get started, our agenda is going to cover what we should be reviewing. It's going to cover retirement contributions, a little bit about open enrollment for those of you who are still working, estate planning, charitable gift decisions, taxes, which are still a murky, muddy area where we're not quite sure how we're going to end the year. So that's a TBD, but we've got our tax expert, Hannah, here to talk about it. And then we'll close up with a little bit of economic outlook. And as we go, I'm sure you may have questions. We would love to hear them. We're fortunate to have updated our presentations now and our Zoom to include a Q&A section. So please let us know what your questions are as we go, and we'll make sure to address them at the end. Okay, so first, I know that this isn't any fancy tax strategy. It's just a good behavior and habit, but I really encourage you to think about your financial goals. Give yourselves a congratulations on the things that you accomplished this year, whether it was meeting a saving or investing goal or making an adjustment in your life. So spend some time reflecting on what you've done. And if you don't feel like you've had those intentional goals, then also spend some time editing or revising or creating the goals that you want to have for 2022. This is the perfect time of year because there is sometimes some downtime, hopefully in between all the busy holidays, and also just setting intentions at the beginning of the calendar year is always helpful. We always love to revisit goals with you as clients when we work with you. So if you need help coming up with good ideas, let us know, and we'll talk with you to make sure that you're staying on track. Also, when it comes to the nuts and bolts of investing, there are goals related to investments, and I want you to make sure that your investments are really matching with your life as it is today. So if there are big changes occurring in your life, whether it's approaching retirement or a change in your financial circumstances, I know many people have changed jobs in the past year, and so maybe that means that the status quo needs a little bit of an adjustment. Then please review your investments in context with the rest of your life. And if you're not sure where to start, that's a lot of the conversations that we have with people as well. If you are managing your own investments or have them in an outside retirement account, make sure that you're able to rebalance or review your allocation in a year where bonds have gone nowhere or slightly negative and stocks have gone up almost across the board. Then you may have more stocks than you realize, which can build in extra risk into the portfolio that you might not be aware that you have. So a rebalance, which we do dynamically throughout the year. So it's not like there's a certain time of year for us when we're managing your investments, but if it's something that you're managing yourself, you may need to have that extra reminder, put it in your calendar that this time of year, you should check and see what's going on. We also have more and more people that we're investing taxable accounts for. So it's not just your retirement accounts where you can make trades and, kind of until you decide to take money out, there isn't a tax consequence. So when you're managing taxable investments, you can have low tax costs or high tax costs. Sometimes those things aren't outside of your control. If you need money and you're taking it out of something that has grown, which is kind of the point, right? Then you may have to pay taxes, but a lot of times you can control the taxes in your investment strategy. So if you have an investment strategy that doesn't feel very tax aware and you're paying more and more capital gains each year, we see that often with clients that come to us asking for kind of a second look. Then that's worth, looking into and seeing if there's some adjustments that you can make in order to not, pay so many taxes as you go. Also, the costs of investments have changed significantly over the last 5 or 10 years. So when you look at the expense ratio of your investments and what you're paying for them, that is certainly something you want to keep track of and manage as well. So it's a good time to just check in, make sure that, you don't need a tune up in your investment portfolio. I always encourage people to think about that toward the end of the year. And then, of course, taxes. We're going to dive even further into taxes this year because there's potential legislation that might impact changes to taxes as well. But review taxes as they relate to both your investments, or perhaps you have a year where you don't have that much income. Things have changed. If you do have a changing dynamic in terms of your taxes, or you haven't made estimated payments, but you've got more income than usual, all those types of things. It's sometimes you can control things more when you're reviewing now versus if you review in March or April when it gets time to file your tax return. And then finally, for my part, retirement savings and Roth conversions. We have another 6 weeks or so before the end of the year. And for some of you, you may want to stuff a little bit more in your 401k than you'd originally set out to do. You also may want to reset your savings for next year because the amount that you're able to put into accounts has risen. And we have some of those numbers for you. Just reach out and we'll tell you what they are. You may want to make adjustments because you're self-employed now and you need to evaluate if you're saving in the best retirement vehicle. So evaluate the options between a SEP IRA or a 401k or a solo 401k. And you might decide that one thing or another is better for conversions. And with that, I'll hand it off to Alexa Kane, who can talk more about some of those retirement savings strategies and specifically Roths.
Perfect. You want to go to the next one? So one thing just that is probably more time sensitive than most things is your required minimum distribution. So if you're over age 72, you do have to take your required minimum distribution out by December 31st, or else there's a hefty penalty to get that taken care of. And also for those people who have non-spousal beneficiary IRAs, if it was before December 31st, 2019, there's a required minimum distribution based on your life expectancy. And if you inherited it after that, you do have 10 years from that date to take it out. So if you're on that second side, there are a lot of conversations to decide what makes sense if you take it a little bit over the 10 years, or if there are years with lower income, you can push it into those years. So just making sure you're taking what you need to timely, because it gets to be a pain if they're not done on time.
A tax pain.
An IRS pain, which we don't like. And then also during this time is open enrollment. So it's a great time. Check on what your coverages are. Even if you're not planning to switch your plan, take a look at the plan, make sure nothing has changed inside of there, know what your deductibles are, what's covered, if there's dental, vision, all of that. And also a lot of employers offer some additional insurances as part of that. So checking if there's disability, life insurance, that sort of thing through work, checking on what that coverage is and if you need things to supplement that, because a lot of times they have life insurance through work, but it's typically one or a multiple of salary, and depending on your family situation, that may not be enough insurance for you. And also you don't want your insurance tied to a job in case you you leave, which we've seen a lot more of in recent years. And then back to your healthcare coverage. If you do a high deductible plan, you are eligible for a health savings account, which is, I love Roth IRAs, but I think I might like health savings accounts even more. So you're able to save into those. You get a tax deduction on the front side. Once you hit a threshold in the account, typically $1,000 or somewhere around there, depending who holds the HSA, you're able to invest those proceeds. And then when you take the money out, if it's used for qualifying expenses, you get it out tax-free. So it's a triple tax advantaged account that we like to see people using, because it does offer a little extra, once you've maxed the 401ks and are looking for additional ways to grow your wealth and hopefully help you retire earlier. And Hannah reminded me on the podcast the other day about if you have the flex spending accounts, to make sure you know your deadlines and that you're spending those funds down before you have to. And the qualified expenses have been expanded from the CARES Act. So look at what you can use those funds for, because you don't want it to go away. And then my last one is estate planning. So it's a good time to check in on all your policies and make sure you have proper beneficiary designation. So the retirement accounts, life insurance policies. Also, if you have taxable investments, if it's in an individual name, do you have a transfer on death? Bank accounts, you can do a payable on death. So just making sure everything is in order there. And then if there are updates and adjustments, making sure that you're getting those taken care of. I also think that the holidays are a good time to, usually we're around the people that that we love and that are included in our estate planning. So even if it's not letting your family know every dollar and cent that you have, if you at least let them know where they could find the important documents, or who the people are, if they have, a name and a phone number of the attorney or of the advisor, it will just make things easier if something does come up. That's me. And then now we'll go to Hannah.
Thank you so much, Alexa. So we wanted to talk a little bit about charitable gifting, as this can be top of mind this time of year. Of course, we know, and we've mentioned this before, typically when you're donating to your favorite charity, it's not done with any personal benefits in mind. But there are some ways that you can consider making charitable donations that can kind of help you make the most of your tax planning strategy, while still providing benefit to the charity or nonprofit that you love. So bundling charitable gifts is one of those options to consider. And basically, this just means combining several years of charitable contributions down into 1 year. And a lot of folks use this strategy to kind of meet thresholds for itemizing your deductions. And donor advised funds can be another way to kind of utilize a bundling strategy. So with a donor advised fund, basically it allows you to bundle your contributions from several years, but still allows the charity of your choice to receive gifts over a several year period. So really, depending on your situation, it can be the best of both worlds from that standpoint. We did want to touch on qualified charitable distributions, QCDs, and this is another option that can really help you kind of accomplish two goals with one strategy. QCDs basically allow you to transfer funds from your IRA directly to a qualified charity. And if you're in the phase of life where you're required to take an annual distribution from your IRA, QCDs can actually count towards that required minimum distribution as well. And then donating long-term appreciated assets from a taxable account can be a really beneficial strategy as well. Gifting appreciated assets basically allows you to avoid paying capital gains, but still allows you the opportunity to take an income tax deduction for the full market value of the asset. So that can be a really great strategy too, depending on your own financial plan and situation. And then finally, we wanted to touch on Giving Tuesday. So Giving Tuesday is a really nice tradition that started back in 2012. And this day was really just started to kind of inspire people to do good, which we love. And this year, Giving Tuesday falls on Tuesday, November 30th, which is quickly approaching. And many folks use this day as kind of an opportunity to make a donation to their favorite charity. So for many nonprofits, Giving Tuesday actually makes up a huge chunk of their annual donations for the entire year. So it's really a great way to kind of help them move their mission forward into the new year. So if you are in a place to give back this year, maybe consider Giving Tuesday as a potential opportunity to help your favorite charity as well. Of course, as with all tax planning strategies, we do recommend touching base with your CPA or your team of financial planners to kind of come up with a plan that works best for you. Okay, so we wanted to touch base on some education savings and expense items. And for many of us with education savings goals, we know that saving for education can sometimes compete with our other savings goals or plans. But if education savings is one of your goals, we do recommend doing a year-end check just to kind of see how much progress you've made. Melissa touched on this earlier, but just to kind of see where you landed for the year. So if you haven't started any education savings yet, but you'd like to, we do recommend checking with your financial planning team just to kind of potentially get information on the process to open a 529 plan. And as most of you probably already know, 529s are just a really awesome savings tool for both higher education and college expenses because they allow your money to grow tax-free, assuming you use the funds for qualified expenses. So just an option that we like to throw out there and a good item to consider this time of year. So along those same lines, FAFSA is another item that we like to remind you about this time of year. I know that this is one that a lot of parents really dread. So if you are one of those parents, I would really recommend checking out one of our recent podcast episodes called Demystifying the FAFSA. And this was with Melissa Joy and Ann Garcia. This podcast gives you awesome tips on basically maximizing the financial aid and merit scholarships that your kids might be eligible for. And it kind of touches on how you qualify or how you can qualify for tax credits and other potential workarounds to basically make the most of your FAFSA application because both spending and saving strategically can kind of help you maximize your child aid and eligibility. So on that note, speaking of tax credits, we wanted to mention the Lifetime Learning Credit and the American Opportunity Tax Credits, both credits that you're going to want to keep in mind if you do have a child in college. They have slightly different eligibility requirements and both begin phasing out at about $80,000 as in earnings as a single filer or about $160,000 as a married filer. But if you or your child is currently enrolled in college, definitely make sure you remind your tax preparer and your financial team so that they can kind of help you determine which credits you qualify it for and also how to kind of work those strategies into your overall financial plan. So to kind of wrap up this slide, we just wanted to remind you that this time of year can be a really great opportunity to kind of chat with your kiddos about money. Whether that's just as simple as, you know, touching base on a Christmas budget or kind of including them in that conversation or having an actual family meeting. We really feel that kind of keeping your kids in the loop on best practices as it relates to your finances or your finances as a family can just be a really powerful teaching moment. So just a few items for you to consider there. And now we'll move on to the fun stuff, the proposed tax changes. So if you joined us for our last webinar, we talked about how many of the proposed tax changes that were on the table were basically used to help fund the infrastructure package. And although the bill is still currently in draft form, a lot of the changes that we talked about potentially going into place have been eliminated from the draft at this point. Keep in mind, these items could be added back to the proposal, or they could be tweaked a little bit, but as of right now, here are some of the items that have been removed. So currently it's looking like the capital gain and dividend rate will not rise for the top tax bracket. And it's also looking like the estate tax exemption will not drop back down to 5.49 million. And then there was also a section of the proposal that would have impacted high income earners with high net worth, basically preventing them from being able to contribute additional funds to their IRAs. This line item has been removed in the current draft as well. And then finally, one that impacts a lot of our clients, it's looking like as of right now, we will still be able to proceed with Roth IRA conversions and mega backdoor Roth contributions in future years. So yay there. So with all of that, you might be wondering what is actually still left in the tax proposal. And the good news is that a lot of the changes that are left in the proposal do not impact a lot of folks that we talk to. But we did just want to give you a quick overview just in case you happen to fall into one of these categories. As of right now, the proposed changes on net investment income tax for S corporation profits is still on the table. So this change would basically impact earners in the top tax bracket, and S corp profits would be subject to a 3.8% net investment income tax. And if you are in this bucket, we do recommend touching base with your CPA just to kind of talk through the phase-in ranges, as it might be even more important for you in future years to kind of come up with a new strategy. And then also for ultra high income earners, there is the potential for a surtax of 5% that would be assessed on modified adjusted gross income over 10 million, and then an additional 3% surtax on modified adjusted gross income over 25 million. One caveat to note here, this surtax does not differentiate between ordinary income or capital gains income. So just an item to keep in mind there. We know that doesn't impact a lot of folks, but just something to be informed on. And then with regard to qualified small business stock treatment, it's proposed that we'll actually return to the 50% of capital gains being excluded on the first $10 million of gross income. We likely would see this element of the proposal impact folks in like the tech industry, possibly the manufacturing industry. And then finally, in terms of the ACA credit and the refundable tax credit, both items have been extended into 2022. So again, at this point, still just proposed line items. Anything could be added back or adjusted further. And we'll obviously continue to keep you in the loop there as soon as we hear any updates. But we just wanted to give you an update on where we're at right now. So with that, I will turn it over to Melissa Fradenburg.
Thank you. I am just, there we go. All right, so as Hannah mentioned, the funding of the infrastructure bill and the bills were actually separated. So the infrastructure bill passed and was signed into law this week, but the Build Back Better, and which includes the funding for a lot of those items, is not yet signed into law and has not been voted on. So I just wanted to give a quick update on what we might expect from those bills. And basically, the moderate Democrats have asked for a CBO score on these bills, and that is expected to be delivered no later than tomorrow. So the House is hoping to vote on the bill. At that point, it will go to the Senate. And of course, anything can change from there. We expect that there are going to be certain areas like paid leave, the SALT tax caps, and immigration that may be sticking points and be changed before the bill is actually put into law. So we will wait for that. But to give you an idea of timeline, again, hoping the House Democrats are hoping to vote on it tomorrow. I actually checked before the webinar today to see if that had happened yet. But likely the deadline would really be December 10th is when Senate is targeted to adjourn for the year. So I imagine they probably have holiday plans and will not extend out till December 31st. But that again would be another backstop because the child tax credit advance payment is set to expire. So that's just giving you an idea of what you can expect to see in the news and the headlines in the coming weeks as we close out the year. Now, we are still looking for, as we go into 2022, that we expect GDP to have a healthy growth rate and unemployment to come down. But there are a few things that you're probably hearing about in the news and thinking about that we are also keeping an eye on as we close out the year and start into next year. And that is the supply chain, inflation, oil prices. So I'm going to start off by talking a little bit about inflation. And you've probably heard the term that inflation is transitory. And we still do believe that it is transitory. And by that, meaning it's not going to be a long-term runaway inflation. We're looking at inflation peaking sometime in either the fourth quarter, which is what we're in right now, or first quarter 2022. And so one of the main reasons for that when we talk about inflation is that historically, when we see times of prolonged inflation, we see the consumer really accepting higher prices and just buying items regardless of how they're priced. And we're not seeing that. We're seeing people not make purchases because of higher prices. And especially now we're seeing that with car purchases and home purchases. Consumers are starting to balk at that increase in price. And I actually experienced that this week. We thought about potentially going to visit family and requiring airfare for Christmas. And for a family of 4, Delta wanted almost $5,000 in airfare. And we're staying home for Christmas now. So the reason I bring that up is that is a good indicator of why we still believe that inflation will remain transitory. And the next slide shows another reason why we feel that way, along with kind of what's going on with the supply chain. So we're actually anticipating that there will be some disinflationary pressures as it relates to expansion in this supply chain. So while you see images on the news, it is very real that there are issues at the port, ships with cargo that is not getting unloaded, waiting out at sea. It's absolutely happening. However, it's important to point out that we actually have seen an increase in container volume processed at US ports. So in fact, they're actually up 20% as far as how much these ports are processing. And container ships ordered in 2021, the most on record ever with 619. Rail and plane, so we have a 5% increase in rail car activity since pre-pandemic levels, and an increase in demand for air cargo since 2019 as well of 20%. So these are big numbers. One number that may look like it doesn't fit that is if you see demand for higher trucking is down 3%. However, what may not be taking into consideration is companies like Target and Walmart and Amazon. They are now handling that in-house. So it's about, just Amazon alone has about 50,000 semi-trucks and trailers that they own. So that, in consideration with other trucking numbers, actually also shows an increase in this capacity. Same with warehouse distribution centers, up 24%, which would be the equivalent of 6,000 football fields as far as increase in capacity in warehouses in 2021. And then if we look at retail customers, everybody keeps talking about Christmas, will there be products for people to buy? But it's important to note that there's actually an increase of 1.5 times what we saw pre-pandemic in 2019 as far as what the top 5 retailers are saying. And FedEx anticipates actually an increase in packages delivered for the holidays. So what all this means in relation to this inflation that we keep hearing about is that if you think about the cargo ships that are out there and the goods that haven't been delivered, if you think about the kind of pricing that we will see on those items post-Christmas, with all this increased capacity in warehouses and in shipping, we did expect that there would be some kind of a supply chain holdup after we open up the economy from COVID. So one, this is sort of expected, and two, because of all this increase in capacity that we're seeing, we think this will actually have a deflationary pressure on pricing as soon as we get through, the holiday season or into next year. Now, we're already seeing pricing come down on some things. If you think back to the pandemic, toilet paper, meat, I know lumber was up because we actually got some quotes for some work to be done, and it was outrageous in the middle of the pandemic what lumber was costing. And we're seeing that in these graphs here. You can see those prices are already coming down off their highs. An example that we at Pearl Planning are fond of is with Pelotons, right? In the middle of the pandemic when the gyms were closed, that pricing pressure, people were paying for their base model $2,245 for a Peloton bike. And they just announced this week that there's a sale. They're now going for, just under $1,500. So we are seeing things, pricing start to come down on certain items. Also with travel, as I mentioned, looking to book flights, a little outrageous for holiday travel, but we did anticipate, because of all that demand as we come out of the pandemic, that there would be price pressure on rental cars, hotel rooms, and airlines. And you can see by these graphs that we're actually seeing that come down off those highs. And we anticipate that that should continue to ease going forward. So with that, I am going to pass it back to Melissa Joy, who is going to talk to you a little bit more about inflation and, some options there. So,
well, thank you everyone for all of the input, because I just think there's so much to cover this year and every year when you're really doing comprehensive financial planning. So hopefully you saw the depth as we covered, very sky high, but across a very wide range of topics. And really it's just scratching the surface, because your personal circumstances really are the base jumping off point for us to make recommendations for you and your year-end goals. But if we're working together, that we're proactively thinking about these things throughout the year. But I always encourage people, this is a great time because people do kind of close the books on the year and then make a plan for the next year. Such a perfect time to think through things. I already have one question in the Q&A, but I would encourage anyone else to scroll across the bottom of your Zoom screen and type in a question if you have one. And we will address those in just a moment. But I had 3 or 4 people ask me, and I think Alexa, should I buy I-bonds? Because there was a great article in the Wall Street Journal by Jason Zweig, and other people have been talking about them. These are a direct issuance from the US Treasury that is for small consumers. And so you can only buy $10,000 per calendar year, $10,000 worth. But right now, because an I-bond, the I part is inflation, an I-bond has a payment of 7%. And so for the next 6 months, you would get about 3.4% paid to you in an I-bond, and you know that rate now. And so I just recently wrote a blog that we'll both send in the follow-up email with the video recording, talking about should you buy an I-bond. And it really depends, because this is somewhat limited for people that have larger cash pools, and you are agreeing to own this bond for at least a year and would have to give up 3 months worth of interest in the first 5 years. And it's possible, if we have deflationary forces, that those bonds could pay nothing in the next kind of interest rate reset. But if you're really concerned about inflation and have extra money that you don't need in the next 12 months, it certainly could be a consideration, and we'd be happy to talk to you about your options there. In the blog article, we have a list of instructions on how to purchase an I-bond if you think it's right for you, as well as the caveats for, kind of a list of, do you want to deal with an extra account? Is that going to be lost in the shuffle later down the road, and things like that. Okay, so a few action items before we get to the Q&A. Map out the last 5 weeks of the year. If there are things that you heard today that you feel like you need to get done, go ahead and give yourself reminders now, because I know you probably have a busy day and it may not be all done today. And then also, it's a great time to go in and put in your reminders throughout the next year too. Schedule a meeting to review your taxes or your investments, things like that. Go ahead and map things out today. We also have a great year-end checklist that's refreshed for 2021. And if you email Hannah as a follow-up to this call, she will send that checklist right back to you. Thanks, Hannah, for doing that. And great presentation, by the way. So Hannah at pearlplan.com, and you'll get that year-end checklist. And we'll also make sure to include that in the recording follow-up. And then if you're not getting our newsletters or invites for things like this, or you saw it on social media, we'd love you to go to our website and sign up for our newsletter under the newsletter section. I want to make sure also we include our required disclosures. As financial advisors, there's a lot of regulations and things we need to disclose. And then here's a list of our contact details if you have any questions. And here is a Q&A. And like I said, we're still open if anybody wants to send their own. Do you see upward wage pressures and above average healthcare costs increase as significant long-term contributors to inflation, or are these low impact? Well, we are anecdotally seeing job offers from people who are mid-career and looking for different jobs that are coming in significantly higher than their current income. And so those wage pressures are going to factor into inflation. I think we're seeing those in the number. Also, same on healthcare costs. You can see if you're receiving Social Security, you got a notification that you got a nice healthy raise in your gross Social Security income, but then right along with it was the increase to the Medicare premiums that, kind of eat up a lot of that in costs so that you don't get this huge, bigger check when it comes to Social Security. Certainly we'll keep an eye on that because, wage pressures can be a significant switch and flip from transitory to permanent in terms of inflationary pressure. I guess what I'd say, though, is revenue and profits have been extremely strong for companies, which have given them, and interest rates are quite low. So those have all given them the ability to borrow, the ability to be capitalized. There is a lot of money available if you're a private company to have extra investors come in. And the question would be, how permanent is that state? So I do think that if I were a betting person, I would be betting on volatility in a lot of different numbers, just like things kind of sloshed down and we had a deflationary period during the pandemic. Part of the numbers we're seeing today could be permanent, but I think a part is a reaction to that deflationary force because you're measuring against those numbers. And so on the bottom end of the spectrum, you're kind of getting a solution to minimum wages that have not gone up or kept pace with inflation, that the employees are just unwilling to work for amounts in a single dollar, $8 or $9 an hour. So I think there may be a more permanent change when it comes to wages, but whether that sustained increase stays on that same pace, I don't know that is. I think that the economic factors will begin to kind of factor in as the labor market normalizes, and also people are training toward the professions where you have those higher wages. And if there's any other questions, I would encourage people to put them in. I'm going to keep an eye for just a moment longer, but we're happy to answer any questions specifically if you reach out to us at the email addresses, or just go to our website. You can find all of our contact details. You can also follow us on social media at our Facebook page at Pearl Planning Wealth. Melissa, for our next presentation, we should add the Grosse Pointe Facebook page as well. So there's Melissa, what is how do you find the Grosse Pointe page?
It is /Pearl Planning GP.
Perfect. And then additionally, our podcast has had, I think, some really outstanding episodes recently. Hannah just did a year-end planning episode with Melissa. We have that FAFSA episode about college, preparing for college expenses is our most popular episode ever. We've got a great episode coming up this Thanksgiving week that talks about linking the relationship between nutritional health and wealth and the strategies that make you succeed or improve in both of those areas. So we're having a lot of fun with the podcast. And finally, we're on Apple Podcasts. So if you would be willing to subscribe there, we would appreciate it. I think that's all of the questions that we have, but I think, right now it's a time of gratitude. And I just wanted to express my gratitude for the team members that joined on the podcast today, because I just feel like here at Purple Planning, we've got a dream team that's able to tackle these topics. And then also for everybody that's listening in, it's really special to be able to work with such a generous group of clients and community. And thank you for supporting Purple Planning. So with that, I'll sign off for now. We'll be available. And when the tax law changes or any other, major changes happen year end, we'll be here. We'll be communicating in our normal channels to make sure that you know what you need to do in light of the certainty of a change. Thanks very much and have a good day.